So if everyone can hear, I'm just gonna continue on the ETFs. All right, I'm gonna go down to the second PowerPoint. I'm actually gonna kind of go down and let you know why I trade the ETFs. Kind of gave you an introductory. Basically, ETFs are basically like one a mix of stocks, and it's no capital gains, and most are liquid. And they trade it more consistently than stocks. The problem with stocks is, a lot of times during intraday and for traders, you don't have a time to do due diligence on an actual individual stock. On the ETF, you're actually, trading a sector. So, what I mean by sector is you may be trading pharma, you may be trading, gold as far as commodities. You may want to trade the finance market. So this way, it gives you a little bit of advantage. If you're involved in, keeping up with the news and what's going on with the macro economics, you can actually, ride a whole sector instead of trying to pick the one individual winning stock. For instance, like on, steel, U.S. steel is a big part of the SLX ETF, and if you see that, um, you see that stock moving, instead of trying to catch the perfect time to get in and out, you can actually buy the ETF on steel and ride the wave up. Okay, and there's basically an ETF for every sector, um, every market. And what I look for on ETFs is I look for a volume traded in a day, just because on low volume ETFs you have the chance of, you have like it's almost like a low flow stock. It can be manipulated easily. So the goal is to ride the wave on um, big big purchases. And with these, and so some of the cons of trading ETFs is basically they're kind of more volatile. You catch the wrong way, you can lose 10 to 20% a day. You catch the right way, you can ride it up. Um, you have one-time ETFs, two-time ETFs, and three-time ETFs. And what that means is that based on the index, that ETF can move three times the movement of that index is basing off of. Okay, and most people that trade ETFs, I mean, it's mostly for day traders or swing traders, on the retail side, and mostly for uh, uh, big funds and quant funds. They'll trade ETFs at certain points, and they have big buys. So the big difference between quants and big funds and retail is when retail, if you have 1,000 to 10,000 shares, if you guys ever traded 100 shares or 1,000 shares, and you put a limit order in, you may get filled. Um, you may get filled. Say for instance, you look at here at the IBI, retail is always they always get their orders filled first. So if we buy 100 shares or 1,000 shares here at 62.40 or 62.50, we'll get filled before the banks, and we'll get the exchanges that you go through, whether it's Nasdaq, New York Stock Exchange. They look at retail and they'll fill those orders first because there's only 100 shares or 200 shares or 1,000 shares. The difference is on banks and funds. They're buying maybe 10,000 to a million shares. And so when they buy these, when they place an order, they're not going to place a market order for a million shares, just because a market order they could start off at 62.50 and it may take them to 66 to get them filled for a million. So they'll set their limit on either a computer done on automatic trading, or they'll place an order for a million shares at 62.50 on a limit. So what you'll see is you'll see at certain points, you know, this here it'll get caught and it won't come back. And for a regular buyer, we'll put a limit order and then we may be rebuy. A lot of the algorithmic and quant trainings, quant funds, they'll leave that order open. They're not gonna chase it. They'll say, hey, you know what, we got filled on 10,000, and they'll leave it open, and when it comes back down, they'll get the rest filled. So they'll set a limit, and what we call that is trails. And on ETFs, all the banks and all the funds, they'll leave trails of where they're buying. And then a lot of times they'll open the orders. They'll stay open for like a week. A lot of the programs on automatic trading is they're kind of reset every week. My background is computers, and every computer program out there is set by humans. So we pretty much have the same information as the banks. We're looking at the same exact charts that they're looking at. They're using the same indicators, but they're programming these computers to buy at certain levels, and that's the advantage that we have having the small orders, is finding out where those points are. Okay, so with that being said, ETFs, they can be traded using historical data. And during the day, I'll often mention in the chat room that, hey, it's like an open book test. We have all the data, we have everything that they're looking at. We get the same news, we get the same information that the banks are looking at, the funds are looking at, and it gives us a little bit of an advantage since they fill our orders first. Okay. Let's see. So, right now I'm just kind of going through the kind of background information, and I'm going to go through kind of, how I identify those pivot points. The computers, they're non-emotional, and that's the biggest disadvantage that we have when we're trading ETFs. The ETFs, they move $1 to $3 within the day, and a lot of times we'll set a limit at a certain point, and it will drop down maybe 30 or 40 cent or 50 cent from when we got in, and it causes a lot of panic on regular traders, or regular day traders. And that's the biggest thing, is kind of controlling our emotions. When we see a stock that's been going down, we buy at a certain point, and it may still go down a little bit more. And those are the type of things that cause losses for retail traders. Okay, so I know I use Thinkorswim to kind of chart, but if you guys have a different platform, I kind of put some resources there that we're going to look at to kind of identify some of the points that we're looking at. So, how quant funds work in algorithmic trading on ETFs, they reset their machines like every weekend. Some of them set it every month, and they'll do streams. But some of the smaller prop firms or private investment shops, they'll go retune their programs to actually trade for them on a weekly basis, and they'll review the numbers, and they'll kind of move it up, and it's always plus or minus 2 on actually these points. So one example, I'm actually going to show people on TD Thinkorswim how we look at the points, but I'm also going to show you another tool I use, which is investing.com. It's real-time data for ETFs, for technicals. For commodities on ETFs, they use commodities. They use the actual futures. So if we're looking at gold, one of the what is that? So on gold, like JNUG, that's actually miners. It's not really. They're made up of a bunch of kind of small stock gold funds, and looking those up for like gold miners. If you look at the ETF, you can actually look at the perspective on each ETF out there, and in those perspectives, they'll tell you everything that's in that ETF. So using JNUG as an example, we'll come down here and we can look at the fact sheet. So when you trade ETFs, you want to know what's in that fund, what's in that exchange, and you want to see, when you're looking at your macro and analysis, it's important to know what's inside, and I'm Gold, Alamos Gold, it gives you the percentage of the holdings, and it tells you what this fund is made up of, and where's the country. So, I know during the day a lot of people they use the dollar um, as kind of a combination of how this ETF is moving. They'll kind of say, I'm looking at DX or I'm looking at GC, which is gold contracts for the futures. Uh, but if you look at the weighing, this is mostly based on Canada stocks. So Canada also has an impact on how this stock move. If the Canada dollar is kind of going up, it moves with the United States dollar. But if it's going up, it's going to impact this ETF negatively normally. You know, Normally when the interest rates and dollar goes up, gold goes down. And the reason that happens is because dollar goes up, it makes commodities actually U.S. dollar can buy more commodities cheaper, so it'll actually drive the prices a little bit down. The dollar goes down, and the commodities it actually goes up because the dollar is not. There's a kind of translation with if we have a dollar and our dollar is weaker, uh, it makes it a little bit more equal. If the dollar is going up, like our exchange rate is a dollar and four, and now we can buy more oil with the same dollar. So that's another index kind of fact that you kind of keep in mind. All right, so now you know what's inside this ETF, and when I look at the gold contracts for the futures, gold contracts for future is saying that hey, this is how much we're thinking gold is going to cost in February. So when I come in here and I look at a gold contract, this gold contract in its futures is a month out. It says right here, it says February 17th. So we're actually looking at gold prices in February. We're buying gold today. If you wanted to trade actual gold, a gold ETF, um, like UGold, there's a 3-time ETF, and this is actually a gold ETF. So, when we trade miners, we're actually trading the cost of how much it costs to actually extract the gold out of the ground. The dollar goes up, it makes the workers cheaper. The dollar goes up, um, it actually costs more to get the gold out of the ground. So that's going to drive the profits of a gold miner company, down. So, they pull gold out of the ground at a certain percentage. They say, hey, it may cost us, you know, 7.80 an ounce to get gold out of the ground. Well, if dollar goes up, now they're paying more. So now it costs them 8.80, which makes their profits go down, which makes, their stock go down because now they're paying more. They're paying more for this commodity. Okay. So, you're looking at JNUG, and this here, they have points, but these points are all established off of gold contracts. So I use the gold contracts, and we use the dollar, because we know that if the dollar goes up, it's going to impact how much um, the future of gold is going to cost. It goes down, it makes the companies more profitable. So this is, that's a little bit of economics that you look at. You see that gold, the dollar here was going down, and at the same time, this is at 10 o'clock. 10 o'clock, the dollar started going down. 10:30. If we go look at JNUG at 10:30, you see that's when it started going up. So there's a direct relation with the dollar and gold prices. Same thing with the gold contracts. If we look at the gold contracts at 10:30, see this is when they started going up at 10:30. Same time the dollar started going down. So that's on commodities. you know, same thing with oil. If we look at the oil contracts, so we can look here at 7:15. It was at its peak on that day, right when the market kind of opened. One of the ETFs for um, oil, 7:15. You can see how it's related to the actual contracts, the future contracts. So all commodities are pretty much they're measured with the futures, and you can make that. We'll make that relation, and I'll kind of go deeper into that. I want to kind of keep going. So, all right. So let's see how we get these points on a historical basis. Every weekend, I'll actually come here and I'll keep track of a spreadsheet. So I do the same thing that quant funds and algorithmic traders and prop funds are doing. They're basically going through and they're resetting their points on a weekly basis. So on my weekend, I'll come here and I'll start looking at the points. So let's go over gold since I kind of went over the gold. What I do is on gold contracts, I always start 10 days. I'll look at 10 days out and I'll take the streams. So I'll say, hey, the 10-day charts on these is 1218. The low is 1171. So right there, I'll say, let me give my stream points. 1218. And then right here, I'll put 1172. So, being knowing what the prop firms and hedge funds and algorithmic trading, I know that these are key points. These are the last 2 days, the last 2 weeks. 1218 and 1172 is key points for gold. Since, in the last 10 days, this is as high and as low. So I take the high and the low, and what I use these for is support. So 1172 or 1171 right here, I would consider that as stream support. 1218 on gold contracts, I would consider that the top. And what that means is on the top, if it gets to 1218, I know that in the last 10 days it hasn't really passed this. I would actually take a short position at 1218 on gold because it's going to have to prove to me that I know that hedge funds, I know quants, they know they've programmed it in 1218. They says, hey, we're going to try to get the maximum we can get. So if we buy a stock at 11.95 or $12, if it gets to 1218, a lot of times they're going to set on their computers to just sell. They're not, unless there's some big news coming. They're not going to do a program update in the middle of the week. They're going to have this set a sale price on 1218. They're going to know at 1172, without any new news or economic news, that they're going to go long at 1172 because that's the stream. They're trying to buy low and they're going to sell high. And so right now the highest point is 1218 for these gold contracts on ETFs. If I look at JNUG or Nugget or any of the miners, I can do the same thing. 668, 940. You can see that it hasn't touched 940 again. And then so I have my streams already kind of noted. So all right, I'm gonna say all right, the streams. These are noted on my gold line here on this spreadsheet. Then I'm gonna say all right, midweek. So what I'm looking for on the midweek is I'm looking for a long tail wick that crosses multiple times, because what that tells me is that banks and quant funds they've set it to buy at a certain point and they haven't got filled. So within that time, like I said, that if they had 1 million shares and they didn't get filled, they're going to leave it open. So I come here right away and I use a TTM wave indicator, which it points when there's a lot of buying pressure. So when I see this amount of arrows on my screen, I know that there's buying pressure right here. And so what that tells me is I see them here, I see them here. I see a lot of buying pressure right here. These are guys that haven't got filled, big purchases. So what I can do is I can zoom in. I see it right here, 11.95. It keeps going across 11.95. Every time we get a big sale, 11.95 is again bought. So I'll look at that and I'll say 10 days. Let me look at 10 days, 20 days, and I'll go to 11.95 and I'll just look. And I just see that, here is all across 11.95 for the last 10 days since, January 6th. 11.95 has been around. So that's going to be a secondary point for me. 11.95. I know that there's buying pressure here. And what that means is that intraday, if I see 11.95 hit right here, it picked up right here and it didn't come back for a while. So this is looking at the look at a 5-day chart. 5-day chart tells me 11.95. It's actually not dropping below that. So that's a strong level of support for me. So if I see gold gets 11.95, I'm going to take that chance to put an order here at 11.95, and it may be plus or minus 2, right? So it could go to 11.94, 11.97. So 11.95, I'm kind of going to put an order there. It gets filled. If it drops to 11.92, then I'm going to exit and I'm going to take a short because I see the next support is at 11.87. Or the major support, actually, if I look through, you kind of do that same exercise. So 11.72. These are minor pivots in the last days, and these are minor, so that's why they're not highlighted, because it wasn't really that strong. It's just an uptrend. And I'm actually going to kind of tell you about the momentum, how you can track the momentum. But I know 11.72 and 12.18 is strong support and resistance. In between, these are key points that we identified as you see a lot of selling pressure, and then you see bounces. So 11.88, I was like, hey, if this guy didn't get filled all the way, I'm going to take a shot at 11.88. That's going to be a small, I call it small technical pivot. It's not a major support, major resistance, but he may have not got it filled all the way. And I'm looking at big banks. Also on my indicator, I see the volume, and I also see this. This is a TTM wave. It's kind of a thinkorswim indicator. It tells me that you had shorts, and it tells me that the momentum is actually a strong, and this is an uptrend. So I always look at the 10 days. I'll come in at 10 days because I want to see the overall how it's looking. A lot of times intraday we'll see it going up and down. If you step back 10 to 15 days, you can see that from 11.28 it's still been on the uptrend, and it hasn't broken that uptrend yet. So from there, intraday I'm saying it's dropping. It has a lot of movement. So what you're going to do for that, you go from 10 days to 5 days, and I look at 5 day and hourly. And I see the support, at 11.95 is, I don't want to buy at 11.98 just because, it's kind of right in the middle. And like 12.07, you see it up and down, up and down. If you're a intraday trader, that can cause you to panic and take losses, and you take a lot of little losses. So, in the chat room, I'll say, hey, wait for save time or wait for entry. I don't buy at the open just because I'm not seeing any, you can't really, you don't have any history. And so like a lot of the ETFs, they're going off of historical basis, like I said. So you can't really determine that in the first 30 minutes of the market. You have no way to really determine. So you're kind of taking a chance. You wait an hour, and I look at the hour chart. I'll at least have a solid red or I have a solid green, on the first hour of the market. So this is on gold, and let me go back. So, like I said, during the I use futures. So during the night, while everyone else is there's less volume at night, I'll actually go look at the futures. Futures, they don't stop. So a lot of times if a key point is done in the futures, and like 1198. These were these minor pivots, and these are kind of like clues for the intraday. So that's why I would have 1198, because in the futures it showed me that it was support. So that means that within the last 24 hours, support could have changed to 1198 for intraday trades. So this happened at 2 o'clock in the morning. I'll use that, and those areas they'll be in between, but I'll know that 1195 they had support at 1198, and then they kind of tapped out at 12. So I'll say from 1195 to 1198, there's a little intraday support, and that's what you use for, and that's what I use for intraday. If I want to take a bigger position, I'll wait for those major support and resistance. If I want to I'll take a smaller position in intraday. So this way, if I get stopped out, but then that causes a lot of trades. So that's just one method that you can use those points intraday. All right, so I think. Okay, so another thing that we have to look at when we're trading, when we look at these charts, I like to call them brainless charts. A lot of guys they'll say, hey, my indicator said this, said that. But one thing that funds they'll look at, and they look at a week in advance. So on my spreadsheet that I look at and I prepare for, I'll have a stock trader almanac, and I'll look, I'll kind of review that, and I'll look and see, historically, January 11th, 18th was bullish, on the 20th expiration, and it'll give me the historical basis for that. So like on January 20th, it didn't account for Trump. So if you're just looking at charts and going by support and resistance, you're not really seeing that, hey, we have an inauguration. So this, even though these stats are here, it doesn't tell you what's going on today. There could be a shooting in Paris, or it can be, someone blows up. So the charts alone, is good, but it doesn't give you the whole the macro. You know, they have the same information. We have the same information they use. We just have to apply it and know what to look for. So, right here, every Wednesday we have oil and gas inventories. Every Thursday we have, on this Thursdays, we have some unemployments. It gives you this, and this is how you prepare for the week. So you want to mark those down of what's going on. Um, in my spreadsheet, also I track weekly earnings and economics. So I'll have the economic calendar, what's going on, what's going to impact. So if a Fed member is speaking and they're going to impact interest rates, that's going to move the dollar, which is in turn is going to move, the dollar is also going to move gold, it's going to move commodities. So, one thing when I was working for a prop firm is, there are certain rules. If they're going to let you trade with their money, they're going to say, hey, you know what? You can't have a position open anytime that there is a Fed speaking. Each prop firm is different, but most of them say anytime a Fed member is speaking, or if you see a three bulls, core CPI index, and this three bulls stands for high volatility. So they're expecting high volatility for these key events for US. They'll tell you, you need to close your position. You can't keep a open position during those times because they don't know what's going to be said. So it limits your odds of being able to, make an educated, guess of what they're going to say. So it's safer to just take the exit that position. Now, if you have like a million, you have a million shares or something, you can't exit the position in 10 minutes. You can't just set an order and say, hey, I want to get out of a million shares of gold. So I'm going to look at the economic calendar and kind of see what's coming up and see if we can identify anything for the current week. So, funds not being able to exit positions like normal, traders, they'll start doing it a day before. I'm gonna look at this week. Oh man, let me sign in. So what I have is on investing.com. It's a good app. It basically, you can track the countries that matter the most to you. What I trade, um, I kind of focus on the euro because the euro and the dollar is related. Well, it impacts, the euro market impacts our market. They're heavily funded or heavily margined. China and Europe, you know, for 100,000 you can get $1 million. That means that a lot of those traders are trading with margin, and margin positions is if they make a mistake, they can end up owing, 3 or 4 100,000 more than what they have. So a lot of times, if the market's getting nervous, they'll pull their money out because their money is heavily margined, and they'll actually pull their money out of the U.S., pull it out of their market. So if their market is bad, and they may put it into ours, or they may pull their positions out of ours. So, you know, Europe, that impacts us. The China market, China, they heavily invest in our market. So if they have bad data, they may exit positions because they are heavily margined out of U.S. stocks, just because they get margin calls. They may have got big margin calls overnight. So they're going to pull some of their, sell some of their U.S. stocks to cover some of their margin calls. And, it's vice versa. United, for U.S. traders, we don't get the margin that they get in Europe or in China. So, it's a little bit different. But the prop firms and quants, they exit their positions. So so if we have oil data, and oil's ran up, say we have oil data on I'm gonna look for oil data. So you have crude oil inventories here on, you got it on January 19th. If the market was going good and they know they have to exit their position, let's take a look at it on January 19th. So they had crude inventories. This is on Thursday. So, they were already out of their position. You see here that they sold their position the day before, and that's why it was a lot of sales before going into the oil report. And then after the oil report, they had the numbers. Now it ran back up. So you can see that Thursday was a day that oil was already up. They started exiting their position a day before. So on Wednesday they're exiting their position, and now on Thursday exit position. It touched major support. You see right here 51.72, and now after the oil report they started accumulating again, and they did it overnight in the futures. So it never touched 51.72 again, and if you're paying attention, it ran up overnight, getting their positions back. And then when the market opens, they're dumping it to retail now. They've already had their position. Now they're dumping oil because they also had Trump and they didn't know. They didn't know if he's gonna, what he's gonna say, how he's gonna impact the market. So they're exiting their positions here. And if you look at the overall trend, oil, you see here it dropped. It was up at a high, they dropped it, and it's like they're playing these ranges. And then major economic news, coming, they're up here, then they're dropping it again. On Thursday, oil report, and now it's coming up, but they're taking their money out of the market because there's major events. Trump being inaugurated was a major event, so you had a lot of low volume market or low volume in the market this whole week. So that's one way the economics and prop firms, they'll have you exit positions. They'll have you, they're not holding into these large positions, but for 1 million shares to get rid of, they're going to do it the day before. So knowing that, it's like, hey, oil's up. They're selling off. So you would wait to a stream, and then you'll say, hey, I'm going to get in. Here's a point, 50.71. You can wait for those extremes. So, looking at oil, they have a stream 50.72. I didn't highlight that one, but that's a stream on oil, 50.72. Then the top is 53.60. So 53.60, unless there's no good news to make it break, those funds they're gonna have it. They're gonna have their machines programmed to sell it at 53.60. And I think I called it out in the chat room on Friday that, hey, 53.43, 53.60, get ready to exit. And at 53.60, it exited. So if you look at the last 10 days, that was the day you wanted to, um, right here, you see the tops, 53.60. You see all these arrows? It was a top. It hasn't hit the new high, which, 54.32. And it won't hit this high unless they have some kind of new news. They're not going to go manually go in and rechange their computers or set up buy order unless they have some new news. They're letting the computers run. It was low volume this week. Nothing changed. They set those indicators for over the weekend at 53.60, and they says, hey, we get here, sell 53.60. So on these extremes, if you're patient and don't overtrade, you can actually just wait for these extremes to happen. Then you take a larger position. Then if it actually passes this and it passes with strength, you can get long. But you don't have to gamble. So you can say, hey, at 53.70 or 53.70, 53.75, you can set alert and say, hey, if it breaks this, I'm going to create alert. It breaks 53.70 because it hasn't. I'm going to say that's a breakout. So at or above, I can even go 53.78. I will set a note and say, hey, go long, because at least I can go long to like 54 because I know that's the next point. So on my spreadsheet here, I'll probably change this point to like 54, and then the next one would be 58. I think 58 is the top. But if I'm long, I would just start protecting I would protect my position at 54, and I will start putting a stop loss, just because I know that in the last 10 days on that future oil, 54.32 was the top. So I would start putting a stop loss in. If it breaks through, then you have to go further, 6 months. And you should say, you know what, there's 55.24. But then I would actually move my stop around there. And of course, it would probably hit at 55 because a lot of people are going to put the same sales. They're looking at the same data. We all had the same data. You had the same data as his funds. They have to exit a bigger position. So at 55 is a good place to go short unless there's some kind of major news that's going to change. All right. So, there you guys know is, how we get our points. And, some people, they only trade the SPX. Some are only gold traders, and they can look at these extremes, and where retail get caught up is we want to trade intraday on everything just because we want to get a trade in. But if we stay patient and you have a spreadsheet, you can say, you know what, I'm not going to go big until it gets to 12.18, and I'll put a big order. But I may be waiting there for 7 hours, or I may be waiting there for 2 days, But this is the safest way to go, is to be patient and wait for a trade. Now on ETFs, I have a watch list that I have with all ETFs. So in a day, if I'm sitting there and if I had to make money, if I was a prop trader, or this is my living, and you had to trade every day, you're gonna look for a trade every day. So you set up alerts and you like trends. A lot of the day traders, it's a visual thing. You don't have time to kind of look up every fund or every stock that's in the ETF. So a lot of them they do use the technicals and they use the visual. So for 10 days, I have a watch list that I set up, and I'm gonna look at a 10-day chart. So I have a watch list. It comes in. I have all my ETFs in one watch list. I look at visuals. I like to use visuals because I can look for the same image every time. It's easier to look for the same type of setup every time. What this is the TTM wave indicator, and this is a 1 hour. This is the 1 day, and this is the 1 week. So I'm looking at stock. If it's trending up and it's squeezing for the whole week, I feel comfortable getting into that stock, and I can get in that stock intraday. But I won't do it at the open because I want to see that first chart, and I'm tracking by the hour. So if I come here and I look at EFV, I don't even know what that is. I'll look at that stock. It hit my criteria for it looks like a visual, and this is kind of a it's not a chart I like just because it's up and down. But intraday, I will look at the, now I'll look at the intraday, and if I see too much movement, that's not something I would want to trade just because it opened, went up, went down, it's going down intraday. I try to look for the same chart pattern every time. So um, one chart that I know that meets my criteria, if I look at the 10-day, I look for the same chart pattern. It's going up every day. It's hitting new highs, and it's trending up. So this way, if I buy at the wrong time, I can hold the position because I feel pretty confident that it hasn't broken my trend. Another one, Turkey. It started up, and it's not ideal. So I'll go through my watch list and I'll just look at the colors, and I'll find one that meets my criteria, you know, of buying. So the reason why I was in uranium, you see right here, it had, um, you know, uranium was in the news. Trump, I used the economics as well. Trump was saying about nuclear power and uranium, so he spoke about it. That was one thing, and then also the trend was going up, and so intraday, I was playing this, and I actually sold around here, but we got in early, and then when I started seeing blue, I exited, and I didn't really look at it that much anymore. Also, you know, having your charts and having your watch list, on a daily, is good. I think so. I use a few indicators that I'm gonna go over for ETFs. Let me bring up my PowerPoint again. So yeah, kind of talked about the key pivots. Not trading economic events or report gas reports. You wait till the results are out because that's what the prop firms are doing. That's what the hedge funds are doing. They're not trading into those events. They're getting out. That's why you see those big spikes at the after the reports, and you don't know if they're doing shorts or you don't know if they're going long. So you normally for retail, I wait till the dust is settled because I already know that it's plenty of support. After about 30 minutes, you're gonna know like which way it is. Um, so we got the key points. So I look at the 10-day, 5-day, 3-day, sector hotness, and that's kind of what I talked about with uranium. Okay. Profit trader is another way you can actually look at the sector hotness. I don't know if you guys have ever used that. This is something specific to Thinkorswim. Before I move on, I'll just go over this real quick on a profit. So profit trader, a lot of people they don't kind of use this or know about it. One of the guys at the prop firm, he kind of like trained me on this as well. You can actually find patterns. So like I said, like most hedge funds and quants and intraday traders, they don't really go through all the technicals. They use certain chart patterns that they like, so they can make a quick decision, based on a visual. You can actually select, you want the bullish trend. You take continuation or reversal, both. These are kind of my settings, and I'm using the previous day to actually do this profit to actually look at things in there. I don't want anything with a descending triangle, anything with a channel down. I'll do a double top, triple bottom. I'll catch something, jumping off the bottom, but I don't want anything just going down. I'm not shorting. Overall, I want the score to be a 4. I want it to be close as 5 as possible. And, ideally you want 5, but you want to be able to get something uptrending as well. So it may be getting to 5. Once you get to 5, there's a chance that, there's going to be a sell-off and you don't want to get caught in that. So I want to wait till it, I want to get close so I can ride it for, an hour or a day. I can use any of my watch lists, or I can pick a specific watch list. So I have one that's 150 of my favorite ETFs that I like to trade, and then I can just apply it. You can say, hey, I want a 5-day or I want a 1-day. Um, you know, so over here in this column, it gives you different studies. You can actually pick CCI with breakout. Pick anything you want. or you can just go off your watch list. And so when I look at this is I look for this arrow here, and I look for uh, I know I want gapping up, and these green arrows are like a buy signals. So everywhere you see these green arrows in profit, you see that it is going up. So I want to catch it right when it's going, or right when it's hitting it, and you can actually have them trigger you, for those. So here it'll give you all the stocks. Right now I have it on everything. So I'm looking at here, doesn't like it. So I'll just, you can click on them and you'll find one that, this one, I kind of missed this one here because it's already up. So I can look at this real quick and see that, oh, it topped out right here. I don't want to get in right now, just because it looks like it's top. But if you're shorting, you may say, hey, this is a good place to short because I'm looking at, it's hitting the top right here. And you can go through and click these, and that arrow here, this dot means it's actually going down. So if you wanted to take a short, you could actually take a short, and it just give you a quick indicator. So right here we found one, Citigroup. Now I'll go to my chart and it says, hey, you know what? I got these two arrows. It's telling me it's on a uptrend. It matches my criteria. And normally I would just have my ETFs, but then I look at this chart here and I see this going down. So this may not hit my criteria on this chart here. I also use the gear. It's another indicator. When this indicator is crossing yellow line here and it hits up here, that means the trend is the demand and trend is strong. So normally I would buy down here, seeing that the yellow line is going to cross, and I would hold until I see it. Once it hits this down pattern, then that's a sign for me to exit. And that's kind of how I use this indicator. So on Friday, I bought Brazil, which is a Brazil ETF. Do it one day. So right here is kind of is where I purchased. I seen it was going up. As soon as I seen it cross this line, I got in at like 39.80, I think. And since I know it was going up, I just had to trust the chart. And I trusted that it would hit up here. It hit up here, and I rolled it. When I seen it dip right here, and I actually got stomped out because I thought it was going down, but it wasn't a strong pattern. And so I actually got stomped out at 40.20. But I looked back. I actually lost track of it and looked back, and as long as it was still trending up, it was still going up. And then right here, where it had a strong dip, and it's also the CCI indicator, which I'm going to explain. I have that. As soon as it hit this line and started going down, it was a sign for, all right, it's getting ready to lose strength. Then about 5 minutes later, it dipped hard, and that's when it dropped. And then this is a force indicator here. It hit this line, and then it hit its uptrend. But for me, I buy here when it's coming off the green line down here. And here I would just leave it, and I didn't revisit. But if I was actually trading just this one stock, I could have just waited and been patient on one stock. And you can ride these up and down because this indicator, this is one of the few indicators that is like an 80% accuracy. So it increases your odds. So you want to use the good indicators and have a good visuals of the stocks you're trading. So if I go back to my original chart and I'll look, this has been trending up the whole time, and it hit 41. So when I bought down here, I know it still has support, the VWAP. I have the VWAP here, and it was above it. So that's one of the reasons I bought, because it was above VWAP. I know it had a high at 41. It was at 39. And it was it was strong, and it's been trending. You buy trending up stock. A lot of times we'll look at indicators and we'll second guess it, but we're not, you know, we're not verifying what we're seeing. You know, we got to trade what we see, not what we think. Because you can think that, hey, it's going to fall, it's going to go down, but what we've seen in the last 20 days is going all the way up, and it's keep going up, and it hasn't stopped. I mean, it's taking dips, but if we just bought here and just held it when it was in the VWAP coming out of it, we could have just held, and we didn't have to get out of it. And there's no reason to get out of it unless you're day traders. And so I came from the swing area. You know, I started off swinging, and I was swinging just based off economics. And so, you know, when I started learning these indicators, you know, it gave me a different insight. So this visual chart right here, 20 days, and I see these I see the wave indicator. It's been blue the whole time, and that's the chart that you want. You know, because I could have got in here and I could have just let it sit. Long as it hadn't changed, you know, it took a, you know, right now I can explain to you exactly what each indicator is, and it'll take a lot longer than the time we have. But for a trader and for a, you know, quant funds, they look at these visuals and they make a decision and they just sit in it, and they have a large amount of money. So they'll see this and they'll say, hey, you know what, it's trending up, and they'll hold it. And you know, and not until it drops below one of these key points where you see these arrows, you know, there's no reason to get out. So 35 would probably be the point you say, hey, if it goes below 35, I'm out. It's changing the trend. The trend is dying. But you know, while it's still going up, it's still good. I have some other indicators, you know, trend break, volume. I have a scoring system, so I can look at a stock, you know, any stock, and I can say, I don't know, give me an indicator, Wells Fargo. Tells me 7. If it's over a 5, that means it's more positive. And this is kind of an indicator I had built with a lot of criteria I like to look at. You know, I could look at ETFs. It works for anything. But I'm looking at these charts here, and it says, hey, this is, you know, it's starting to recover. It's going up. You know, and the trend is actually changing right now for Wells Fargo. So, you know, and the score is over. You know, it's giving me a 70% odds or better. You know, as long as it's over 7, then I think it's a stock I'll look at. On the ETFs, same thing. So if I see Wells Fargo going up, I will look at FAS, which is a financial. And same thing here on the financial. The score is still below 5, so I wouldn't really get long until I seen over a 5. But if you go through a shorter period, it's telling me don't look at it yet. It's not giving me a score, and it's blacked out. So, you know, if something was good, my indicators would tell me, you know, it's a quick visual, and that's what you want for your indicators. You want something that's going to show you a quick visual. I see this TT wave, but it could be topping out. So, you know, it's not going to give me what I want until it matches my criteria. Same thing. So it has selling pressure here. I see the demand is going down, and the score is under 5. And that's why I say sometimes you just have to wait. You know, you have to be patient. You can't force it. I mean, you can make money here a little bit, or you can get into something safer. You know, and the same thing with this one. Look at the 5-day, 3-day. It's telling me, you know, on the 3-day that the last 3 days has been good. The 5 days, 5 days it dipped. So if I look at the 10-day, you had two little downtrends here. So that's why the 5-day didn't give me a score. But on the last 3 days though, you know, it's been trending up. All right, so I'm gonna get back. So yeah, it's looking for sector hotness. You know, you can use a profit trader. Use your charts, your indicators. You know, and it gives you a quick visual on the ETFs. You always got to include the economics though. I mean, because they're charts, and they're brainless charts. So you know, you as a human, you have your responsibility to actually know what's going on. Another thing I'll read every day to kind of keep up. You know, something that's free, just the Yahoo briefing. You know, if I see top gainers, I'll kind of note those down, and I'll put them in my ticker signal, and then I'll look at the index. So if it's telling me, if I see financials and I see Wells Fargo or if I see some of the same consumer staples, consumer discretionary hitting highs, uh, then I'll go to another site called 12 Stocks, which I use for ETFs. So this is like a little free site, and it gives you the intelligence of the market. If the market is bullish or bearish, real quick, because it adds up all the scores of all the stocks, which ones are hitting new highs. Um, and they have a section for ETFs. It tells you which markets are going up. So if I see Europe at 83, and SP 500 is at 78, it tells me that the market is going up. It tells you which ones are going down. China, is at a 50. It's at a halfway point. I actually shorted China with FXI puts based on their data. So if we look at FXI, it's still been trending, but you can tell here that this red is telling me that it's going down. So I bought some puts for February on it. If I look at the 10-day chart, I can see it topped out, and now it still has selling pressure. These here is going from cyan is going down. You look at the blue indicator. When you see like red indicators or yellow, and red, it's telling you that the trend is kind of changing. And you see here in the VWAP, it's kind of, it's hitting the VWAP and it looks like it's going to go back on the downtrend. So I'm actually reading some of the comments. So, you can use these for stocks, but I use them for ETFs. So let me get to the ETF section. Best performing. Top performing sectors. So, at a glance, it can tell me that, oil services, the consumer services, these have been hot since the year open. Which one started off strong. Over the last week, you can see consumer staples, oil services, and looking at Yahoo, I just seen something hitting this high, UVV, and here it's telling me right here that over the last week, consumer staples has been hot, and it tells me the actual ETF for it. So if we look at XLP, we can see right here it's starting to break out, and it's at 52. I think I like 10 days. I see all the blue here. It's real quick. I don't even have to. You don't even have to know what the indicators mean. If if you're not that technical, you can just look at these charts and you don't have to overthink it. You says, hey, you know what? I'm looking at the hour chart. It finished the last 3 hours strong. It's trending up. It didn't hit the high, so it would be something I would look at on Monday because it's finishing strong. It's still in the uptrend. The score is over at 8. And you don't have to overthink it. The data is already telling you that, the data is telling you that it's trending up. The best stocks to buy, this whole sector is up. Over the last week, it's been the top sector. There's nothing else to think about until it starts going down. It hasn't went down yet. You ride it. And I can look at XLP. Now, what I like to look at is, how they open. So for timing. So certain days, it gives you better odds. Quant funds, they look at that too. They look at, what time to buy, what time to short, within a day. So we've been looking at weekly, the 10, 20 days. Like, I have the stock trader almanac. It'll actually tell you the best days to buy stocks, what's your best chances of success, what hour to buy. You can look at here, and I'll look at the last 3 days and say, I want to look at the day. Right here, it kind of gaps up and it goes down. Here it was up and it went down. Here it opened up and it's going down. So just looking at the trend, I'm not going to buy at the open or in the first hour because I'm looking at the trend and it gaps up and it goes down. Then midday around 9:45, 10 o'clock, you start finding support every day, 9, 10 o'clock. That's why I say it's an open book test. We have all the data here. You see right here around 10 o'clock, and I will set up a time on my chart. I would say, hey, you know what, ticker XLP. I would put some pivots. This is called being prepared. Put pivots. All right, 52. That's a low. 52.37 here. So I know it's going to cross 52. The last 3 days it crossed 52.20, 52.30. So I can say, you know what? I'm going to try to pick this up. 52.30. Don't buy at open. Check. This increases my odds. 10:45 a.m. And then I can put, what price I entered. And then, I can actually track that. So, I mean, like, just look at the data. Everything is open book, especially with ETFs. Because if it happened at the same time every day, and you looked at 3 or 4 days, and it's trending up, it's telling you what the funds are doing. They're buying at the same time. They're buying around 10:45, 11 o'clock, and you just stay disciplined. 10 o'clock, 11 o'clock, and then you say, you know what? I'll have a whole list, and I'll say, oh, it's 10:45. I'm gonna check this stock. Oh, at Euro, it normally gaps up and goes down in the first 30 minutes. I actually know exactly time. So, if I buy at 7 o'clock, it normally gaps up around 7:30. It kind of goes up. It was doing that when I was buying it in the last 10 days. So, here 10 o'clock, went up. This one is probably not a good example, but some of them you'll see that, what times they go up. And that was a bad example, but you just have to look at the data and then you kind of document it. I have all my tickers, and I kind of cleaned it all up because I know I was showing you guys. Let me see. Here's my normal spreadsheet. So you see here, I had like EWJ, buy 7:15, buy around 7:15. Here it says look at after 8 o'clock. So if I look at CXW, so this I had this on a couple of days ago. So I wouldn't even look at it until like after 8 because it gapped up and it always went down. So I was saying look at it after 8 o'clock. After 8 o'clock. So it's just kind of notes to tell me that don't even look at this stock until after a certain time. So mobile, I had a, like if I'm gonna look at a stock, I'm gonna write all the information down on it. I got like notes for puts on CMG, expecting to miss by 60%. So I mean, you kind of just note that down. NRG, I actually been long in that stock. So these are stocks that were long. CXW is a prison stock because of Trump. CACQ is a Caesar holding, Las Vegas, Las Vegas casino because of Trump. NRG is a stock that's just been in a trend. This is not even ETFs. You look at the 20-day trend. It's a chart I like. I can just look at it and say, you know what, it's going up. And I actually bought it at close at 6.16 because the trend is still up and it's been up for 20 days. So I'm not gonna like psych myself out and say, hey, it's gonna go down now. It's going up. I'm gonna keep riding it. So that's that on just trust what you see. Don't overthink it. And if it's been trending for the last 20 days, you may get in and it goes down, but the chances are it's going to keep going up until it goes down. But being a day trader, we get in and we kind of get nervous. I bought X and I got stumped out just because I was nervous about, the drop. But I know Trump was coming and it recovered. So we had it here and it got stopped in and out, lost money on it. But the trend, because of economics and because it was Trump, and he had his inauguration and he's big on steel, you know, I could have bought steel, but when I seen this go down, I would stay away because it's not a chart that I love. So, it's kind of being undisciplined. You buy the same chart every time, you kind of know what to expect. When you start buying charts or things that look different, then you start psyching yourself out, and that's part of the emotions, and that's where the quant funds, they don't have those. The computers don't have those emotions. So here's a kind of overview of the indicators that I use, and simple moving average. You guys can read that. Volume, CCI. I know that a lot of prop firms, a lot of hedge funds, they use the CCI and they use a Laguerre. And then the TTM wave is something that a lot of people that has Thinkorswim, that's what they use. Pretty much the MACD and the volume, simple moving averages. That's what retail traders, everyone knows, what those are. And you want to have some of those indicators because you want to know what the general the general retail buyers are thinking, and you have to know what they're thinking. You have to know the economics. The much information you have, um, you want to use all of that information, and you can set it up where you only trade things that you're comfortable with and you've seen before. All right, so this is something that is underrated, and it's just the regular market psychology. You know, a lot of the quant funds, if I put this here, a lot of the quant funds, they know what retail traders are thinking, and they have different ways to kind of mess with them. If they know that the points are, 52.50 on oil, or they'll let it drop under. So that's why, you know, you'll see these drops, and they'll let them drop, and they'll pick it down. They'll change it by one or two, just because they know that everyone's looking at the same charts, and so it gets me too. Like I was in natural gas, and I had a point at 320. 320 was a point historically it held, and it dropped to 318. And I think it's going to keep dropping, but you know, actually it was 324 right here, and I got stomped out um, at pre-market because the point was 325, and they let it go down to 324, and it was pre-market, and I couldn't tell. As soon as I sold it, gapped up, and I caught it in the room, and a lot of guys stayed in, but you know, I'm human as well, and yeah, I let it go, and I took like a 5 cent loss, but and then it gapped up and went to the top 340, and then it fell there, but I got the short here on DGAS, and I made money back, but I could have got it both ways. So, uh, so the market psychology, stock trader almanac, I use those, and trying to think of what else we can go over. Someone just asked what's the red indicator on the top that gives a score. That's an indicator. That's a script I put together to look at the trend, the MACD. I basically I score everything. So if the MACD doesn't meet my criteria, if it's not you know trending up, it doesn't get a high score. The trend. These are all the regular indicators that regular individuals use, retail. So I put that indicator there so I'll know what the general population is thinking. And so if it's a red, I just don't even buy it because I know that I don't even have the retail buyers on my side. The banks, they're gonna buy, and it's gonna pop up. But when everyone's buying, it gives you the safest odds, and you can see that it's down. It's actually trending down. Uh, my wave is down. It may pick up, but why even deal with it? Just go get one that has your same chart pattern every time. All right, let's see. All right, yeah. So it's all about preparation. So one of the things I also look at that I haven't mentioned is I look at the most active options. So, you know, this kind of, option traders, they're kind of projecting the future for us, or at least that's what the sentiment is. Normally, I'll find something that's over 300% that had a lot of daily volume that's over 2 to 300%. So, you look at BMY, if it has 800%, but it's mixed, I wouldn't look at it. Only I want to see the lopsided stuff. G&E is over 200. It has calls, so that would make my hit list for Monday. I will put that on the watch because the call volume is up, 72%. The daily volume in options is up 200 over 200%. Then I would take a look at the chart, and then that's how I prepare for the week. So I know what stocks I'm gonna look at during the week. Since it's under here, it's like it needs to be trending up. I'll go look at the Laguerre to see how it looks here. If it's actually looking like it's going to turn here, right? So this, when it crosses this, it's telling me that it's getting ready to turn. Oh, nope, on a daily. So on the daily, if it's going down, I'll watch it on Monday. I want to see this start turning up, and I want to see this start turning up. But it will just be on my list because I know that the call options are coming, but it doesn't meet my criteria right now. It's under the cloud. This is not turning up. But intraday you can play it. You know that there's a lot of interest and a lot of people think it's going up. But right now it's red. So I would probably write it on my uh, list. I'll put it on to watch, like G watch call volume crazy. Wait for entry. And you kind of make those notes to yourself. So this way, you don't want to buy anything that you're not prepared for, that you haven't looked at. So like a lot of momentum stock and day traders, and they'll get Momo stocks, but they haven't did any research, and they'll just buy. So each of them you can look here and it's like it popped up, and I bought it in a small account, but there was no, you can't consistently win that way, just buying, sporadically. If you can prepare, a week, you prepare a week in advance or on the weekend, you can know all stocks you're gonna buy during the week. Um, you know, and you can document them and you can write notes, and you can have a lot of stocks, and you just trade what you see. So like a lot of these stocks here, they met my criteria. You look at I can pick any one of these out and tell you criteria about any of these stocks. NVGS, you kind of look at it, it kind of meets my criteria of the stocks I like to look at. The last 20 days trending up, so even if I bought it and it went down, I can know I can hold it because I researched the stock. I know what's the indicator. I know that it meets my criteria, and that's kind of how you want to prepare. So for your ETFs, I know I've been buying Brazil. If I wanted to buy something, I know I'd always look at Brazil because it still meets my criteria. I know Trump is president, so I'm always gonna look at still, you know, and it may not meet my criteria, but as long as he's in and he's gonna mention it, I'm gonna look at it, and then when I start seeing the trend form, it's good. NRG, I've been looking at that stock for 2 weeks and buying it in and out. So these are the charts I want to look at. NRG, Brazil, I want them to look the same every time. So this way when I see them, they look similar. I'm not trading something that's foreign. All right. So I think I'm gonna look and see if you guys have any questions real quick.
You said you're open to questions.
Yeah, do a couple of questions.
Yeah, I have a question regarding about why the banks and hedge funds trade the ETFs. Because you were talking about regarding about capital gains,
Right,
but I thought that all short-term capital gains are the same.
right. So that's on the tax side. I just know that the capital gains on exchange traded funds is not the same as because they're actually trading a kind of like a note. It's like futures. You don't have no pattern day trade pattern. PDT rule. There are certain restrictions on uh, certain allowances on ETFs that they do get a tax advantage. So I mean that's something you can look up, but I know 100% for sure that they get a tax benefit for buying ETFs. A lot of investors, a lot of long-term investors, they buy ETFs for that reason.
I just posted a link for it.
Okay, there you go. Yeah, so I'm not able to speak on it 100% on taxes because it's definitely a corporate and a hedge fund and a bank thing, but you can look it up. It is a fact that they do get a tax tax advantage. Okay.
Can I ask a few questions about your backstory?
Yeah,
Hey, so how long did you trade at a prop firm for?
I did for 30 days. 30
For
days.
30 days?
Yeah, 30 days because I have a business, and so the business I have, I make pretty decent money. I have two businesses. I went there to try it out, trade their money, and the way that they, all the rules and restrictions they had, it didn't, it kind of throw me off the way that I like to trade. Um, and after trading for 30 days, I wasn't used to the volume, so I was trading 100,000, 150,000, and I was making money initially. I was trading like 1,000 shares, my normal amount, and their goal was they were getting, they're getting a percentage of your winnings, the money that you're making, and so I made about, I was making about 20,000, 30,000 a month, and they were like, well, I come in there new, I start making money. They say, hey, trade bigger, like make, like, hey, why you exit trade so early? They started kind of messing with my site. They wanted me to make, produce more income, and it's like, well, that wasn't my style of trading. And so after the end of the month, I made like 25. They took half. My trade fees were like 3,000. I had a desk fee of like, 4 or 500. And at the end of the month, I made like 25, 30,000, but I only took home like 12 or 13. I make more than that in my business. So, after I spending, all that time, I was like, hey, it might be better if I just trade on my own because, I couldn't, you know, they burn traders out, and so they're hoping to make money off their traders. Like they're not making money off the stock market. Prop firms are making money off the traders. So and they have their rules where even if you win or you make money or not, they're still gonna make money. And basically, you have to put a lot of times you put money up for draws, like maybe 5 or 10 grand, so they can test you out and see if if you lose money, they have a little cushion there. So it was just a lot of stress. Trading volume I wasn't used to. I was trading my own account, and then go there, you trade 100,000, 150, or they're telling you to trade more. It throws your trading off, and then you feel more pressure. You already had a market; it's already stressful. So that's kind of the reason that I took off of work. And I make more than 13,000 a month. So when I had to split half, and I had all the extra stress, I was like, you know what, I'll come back later. But for right now, I'm gonna keep perfecting my own strategy. And like I said, they would fine you if you didn't exit, or they'll close your position out. So they didn't care if you took a loss or not because you had money backing it, and they would close you out. You know, if you got too close to an event, or if you forgot about the event. They have desk managers looking over all your trades. Talking to you about every trade, and now you're already thinking about the market, the economics. Now you're thinking about the pressure that you have. So I got to talk to a lot of good traders, and that was like the best experience where you get to learn other strategies. The prop firm, they were building their own algorithm, their own automatic trading. So I get to see the rules that they set, and every weekend they would retweak it. So I got to learn those points, and then I just bring it back and start trading my own. And this way you can trade on your own pace, and you can go big. When it gets to those certain extreme points, you're not forced to trade every day. Because if you work for a firm, they want you to make money, but they want to force you to trade every day too. And it's you can't trade every day because some days it's not ideal to trade. Market volume low, or you know, and then you have desk fees is running. So if you don't trade, you still getting charged.
I have one more
All
question.
right.
So just from your experience at the prop firm, um, uh, you got to learn from a lot of people, right?
Yeah, I mean, they'll put you under someone, and if you want, you'll split some of your gains with that person. He made a 20%, 30%, but they have different styles. Like no trader's the same. So like trading is an individual, it's an individual sport. Like you have to like trading. It makes you like learn who you are because some people are greedy, some people are scared, timid. Some people take big risks. So like someone else can't teach you to trade. You almost have to find your own like comfort zone because you know like if you try to copy someone else, like some guys are open, they trade Momo, penny stocks. I can't trade it because I don't have a plan. So like for me, my background, computer science, have a degree, have a business, IT. Like I like to plan. You code a computer program, you plan it out, you plan every step. So for me, I can't trade fast moving stocks. So that's why a lot of times ETFs, I don't trade gold or you know it's hard for me to trade those because I do have emotions and when things go different than I plan, it throws me off. So, everyone trades what they're comfortable with, and it fits their personality. And so in ETFs, I find slow moving ETFs. I find ETFs like uranium that was based on Trump and his nuclear economics. I could plan it out. I can look at the times. I can look at when I wanted to enter. And it moved only 50 cent to 80 cent. So I can go big at certain areas and make money off of it. But if I traded, if I hopped in something that was moving fast like natural gas or degas and it's moving too fast for me, I got stomped out, a lot of times. But then when I watched it and traded at the top, I knew at 340 it would bounce, and that was a better trade for me. That's why I don't trade the pre-market. All right. So I had another question. Feelings on trading a leverage ETFs longer than intraday? Yeah, I mean, for me, it's like I can't control what's going on after night, and so that's you know, if I see the trend like uranium, I could trade that for a couple of days. But something is being changed in futures. It's based off futures. It's hard for me to trade because I have no control. And so if it does something I don't expect or anticipate, I'll stomp out. And so other people they can trade. They have a bigger risk tolerance. And for me, I kind of like to be in control of my trading. So that's not my style. But everyone has to figure out like what their risk is. Like Brazil, I could have traded at 24, but it would have took money out of my trading capital, so I didn't let it sit there. Because then, like some people like the action, they want to trade every day, and so like to me, it's fun to trade. I make money already, so if I would have just let it sit there, it would have been a good play. And it's based on your personality too. So that's why I had to lead a prop firm because I couldn't be forced to trade every day. Like it was too much pressure. So, I know we're talking about ETFs, but ETFs is also trading, and these are kind of like trading lessons that, you can't read in a book about market psychology or your own personal, trading style, right? So you work slower too. All right. So I think we're kind of like 15 minutes over. I'll take one more and we'll close it out. Any more questions? All right.
The TTM wave indicator, when you had it on the watch list, how do you go about reading that off of the watch list, the static watch list like that?
Right. So basically so basically what you can do is you come here and you can customize. You can customize it. You set your studies up in the charts. Um, so when you come here and you hit new, you I have a code. I can provide it to you guys at um, um, Let me see if I can find it real fast. I haven't used it in a while. Okay.
Oh, okay. So it's just custom scripts.
Right, just custom scripts, and then you add one for. I'll show you kind of just real quick. So you come here. So now it's in there. Oops. So I can just go okay. Now it's in my list now. So if I go to my watch list again, come here, customize. And what did I name it?
Sample something.
Right. Okay. I just hit this one. I'll do it again.
So those colors are just showing you know, whether it's squeezing or not, or whatever the.
Yeah, whether it's squeezing or not, and you know, because that's something that I want to look at. So if I added it here,
Cool.
now it'll show me another one. Maybe I want to so I'll put a different requirement. I may do like a month, and then this way now it's here a sample, and I could do it for like a month, and now I want to see all of them blue for like the last month. You know, oh shit, I messed up the chart. Take it out.
Awesome. Well, I appreciate it, man.
All right. Yeah, so I mean that's basically what it is, and then your watch list. This way you can see it in a real quick. So if you're in the middle of the day and you want to trade something, and you see it, it's like, oh damn, you can go long. It meets all your criteria. The chart looks so good. And then you just find an entry for it. So you can see that the SPY is picking up momentum, and also you see that it topped out here. So it's getting kind of close. It gets close. They may it may drop it open. So like if I had a position and I was short, I may wait, but if you've seen this, you probably wouldn't want to be short unless you had some other indicators. I actually went short on LABD on Friday. So it met my criteria to actually go short. It looks like it's trending up. It's starting to change. And if I get anything from Trump, over the weekend, he tweet or say something bad about pharma, I was playing that. But if it doesn't go up, I was selling pre-market. So if nothing happened, I would just get out and wait because I know I'm actually getting kind of high here too. So 1585 is top. This is a bottom, but it's starting to trend. The trend is up, and I see support at 1450. The banks for some reason it's holding that line. At like 1450, it's crossed 3 or 4 days. You know, so it's kind of in the range with XBI. It's in the middle point. It can go either way right here. But I know 6240 is support. So if I was if I was fun and I wanted to wait off on Monday, things are going on the weekend. I know at 6250, that's where support is at, and this score was low, so on XBI, so I'm thinking it would drop and it's going to bounce off 6250. So the LABD wasn't, it's just emotions. Like if I hold it now, and I'll see it bounce, I'll wait to 6250 before I sell it, unless it just gaps up. But otherwise, this is trending down. Everything about XBI is actually going down right now. It hasn't hit a new high. It's trending down. Now it's just emotions. So normally when I was swing trading, that's what I would look for. and I would hold for a week or two, just because I know where support is at. So it's going to touch support and bounce off of it, and if it doesn't, it breaks. It's going down even further. So it's in a it's in a critical stage right now, and I was hoping for a tweet. I was hoping for a Donald Trump tweet. All right. So that's kind of the play, but I would probably get out pre-market because I'm not gonna risk it, but it can go either way right here. So that's good, man. Well, thanks everybody for taking out their Saturday, coming out and chatting with me about the ETFs.